Welcome to Your Money, Your Goals, a financial empowerment toolkit. This is a video training series designed for trainers to help prepare you to train potential users of the Your Money, Your Goals financial empowerment toolkit. Primarily, these are frontline staff and volunteers from organizations that work with people living with low incomes or those who are economically vulnerable. This is video 3, Using the Tools, an explanation of how the tools are covered in the training. If you are viewing this video, you've probably already viewed the first 2 installments. Video 1, Getting to Know Your Money, Your Goals, an overview of the CFPB toolkit, and Video 2, which was an overview of the training. And now we're going to be moving into using the tools, an explanation of how the tools are covered in the training, as well as the toolkit. As has already been covered in the other 2 trainings you've viewed, the purpose of this training is to provide you with an orientation to Your Money, Your Goals, the CFPB's Financial Empowerment Toolkit, to provide you with an overview of the training for frontline staff and volunteers, and finally, to provide you with the tools, knowledge, and confidence to provide this training to your people in your community. The objectives for this video are the same as they were for the other 2, but they are worth mentioning. So, by the end of this entire video series, including the one you're viewing today, you will be able to describe the key functions of the CFPB and its rationale for developing Your Money, Your Goals. You probably have a great sense of this already. You'll also be able to define financial empowerment and differentiate it from other terms used such as financial capability, financial education, and financial literacy. You'll be able to describe or explain the overall organization and content of the Your Money, Your Goals toolkit. And this was, as you remember, the key focus of the first video. You'll also be able to list and describe your responsibilities as a trainer for Your Money, Your Goals, something that we also covered in the first video. You'll be able to explain the tools or resources you have at your disposal to plan and implement the training, as well as the overall flow of the training, including key activities and methodologies used throughout the training. So that's the objective for the overall video series. Today, we're going to focus on what happens in each content module. This is something you may remember seeing from the last video. It's a snapshot of the overall flow of the training that you will be providing. You may recall the training itself kicks off with an engaging opener activity called Money and Me. This activity brings up a lot of the information that's covered in Introduction Part 4, which deals with the emotional and cultural influences on financial decision-making. You'll then move into an overview of the training and introductions. Again, that's not something that's covered in the toolkit itself, but it's an important part of any training. The rest of this training pretty much follows the toolkit in the order that it's presented. And what we're going to be covering today is everything from the Financial Empowerment Self-Assessment in Introduction Part 1, all the way through to Module 9, Protecting Your Money. We're going to begin with the second tool in Introduction Part 1, the Financial Empowerment Self-Assessment. We know that some people find the idea of providing financial information overwhelming. Many feel like they just don't know enough about it. The truth is, no one knows everything there is to know about financial empowerment. Since it covers such a wide range of topics, it can be hard to know where to start if you do want to learn more. Identifying what you know, as well as what you don't know, can be a place to start. First, they may see they know more than they think they know. And second, they will find the areas where they can benefit from a little bit more information or know-how. In the training, you'll ask the participants to complete the Financial Empowerment Self-Assessment, which has 3 sections. Then, you'll review the answers with them and have them discuss the reflection questions that you can see on the slide in pairs. You should note that the answer key to the self-assessment is actually immediately following the tool in the toolkit. Be sure to ask participants to not look ahead when completing Part 1. Here is an excerpt of the first section of the Financial Empowerment Self-Assessment, which includes knowledge-based questions. The participants will be asked to respond true or false to a series of statements. Parts 2 and 3 of the Financial Empowerment Self-Assessment change up the question format, with Part 2 having them rank how they feel about different aspects of financial empowerment, and Part 3 basically asks them to think about their experience with different financial products, services, and situations. Parts 2 and 3 don't have right or wrong answers. The next assessment tool is Tool 1 in Introduction Part 2, My Money Picture. The tool is presented by reviewing the purpose of the tool and its contents, and continuing to the next slide to review the analysis procedure. Using the responses provided by the individual you are helping, as well as the answer key, you can use this tool to figure out which module or tool to target to start off with. For example, if someone answered no or I don't know to do you have dreams for you and your children that require money to make them happen? They could go straight to Module 1. So that's really how the assessment tool is set up. Based on the answer, you know where you can start with different people based on the responses that they provide to the assessment. But because there are other strategies for bringing up the financial empowerment topic with individuals besides the assessment, there are two options for continuing this dialogue in the context of the training. One is to have tables brainstorm specific opportunities for beginning financial empowerment conversations. The other is to act out a skit using the scripts that are provided in Introduction Part 3 and have the rest of the group react to those skits. Now we're going to turn to the content modules, and we're going to start with Module 1, which is setting goals and planning for large purchases. To begin with, you want to just talk about the SMART goal framework that is used in this module of the toolkit. SMART means that the goal itself is written in a way that is specific. A specific goal has a much greater chance of being met than a general goal. Measurable means that someone should be able to track their progress towards meeting the goal. The goal also needs to be able to be reached, relevant, which is a goal that matters to the individual writing it, and time-framed, which just means that a goal has a clearly defined deadline. To emphasize the point of creating strong goals, you will use specific examples to illustrate why something is a hope, want, dream, and not a strong goal. Review the examples and ask participants to list the things someone needs to reach their goals. Module 1's first tool is the Goal Setting tool, which can help with the process of setting goals. Use the graphic on the slide to discuss the 4 parts of the tool. Review how each step guides the individual from the basic hope, want, dream to creating the weekly savings target to successfully reach that strong, SMART goal. As we saw in the last slide, the action plan is the third part of the goal setting tool. The purpose is to take the goal and then break it down into measurable, relevant, small steps that someone can achieve. They will also establish the resources they need to achieve each step, the date to complete each step, and when it's complete. For example, say my goal is I want to pay my bills on time every month starting in August. I would collect my utility bills, phone bills, and documentation of other payments that I make each month. That would be step 1. Step 2 would be to go through those and highlight payment amounts and due dates. I would print out the bill calendar tool and set that up so that I have a visual reminder of when my bills are due and how much is due. The fourth would be to consider using the automatic payment methods for some recurring bills or online bill payment. Another thing that you'll teach in the context of the training is how the participants can help individuals figure out how much money to set aside each week for goals that require money. And this is a very simple calculation. It's just the total amount needed to reach a goal, which in some cases may require some research, divided by the number of weeks to reach that goal. So that's just counting from now until the deadline that's written by which to reach that goal. Divide that, and that's the amount to set aside each week. The reason it's each week rather than each month is that many people with limited resources actually think about their money on a day-to-day or week-to-week basis as opposed to month-to-month. Also, because many people get paid on a weekly basis. And finally, so that this calculation works nicely with the cash flow tool, which looks at budgeting on a week-to-week basis as well. That's just about taking a goal and breaking it down into steps, and that's a really important aspect of the goal-setting tool as well as the module. A life cycle event is something that happens, planned or unplanned, that many people experience generally at specific life stages. A large purchase is something that's generally only purchased one time in life and requires more money than most people have in disposable income from a paycheck. Examples include childbirth, large medical expense, or a death in the family. For this activity, you will divide everyone up into small groups. Assign each group one of the scenarios. Instruct the groups to identify what life events the individual is likely to have already experienced, likely to experience one day, as well as any large purchases you can see in their future. Ask each group to draw a life path for the individual and mention they should be prepared to present. Following the life cycle group activity, continue with the small groups by asking them to discuss these questions. It can also work effectively to return everyone to the full group to process these questions together. Here is the clip of Tool 2. Present how to complete the tool using the instructions in the facilitator notes. Tool 3 covers the topic of buying a car. A vehicle may be a lifeline for an individual or family if there are no local employment opportunities or inadequate public transportation options. But it can quickly become a financial burden if they don't learn how to protect themselves from getting stuck with an auto loan they can't afford. Present this tool to the participants by reviewing the points made in the toolkit. At the beginning of each content module, there is a chart that lists options for frontline staff or volunteers to go over tools from the toolkit based on the amount of time they have available with someone. These charts have been included at the end of each module in the training and can be effective discussion starters for ways to integrate the tools into the work of frontline staff. At minimum, highlight the suggestions on the slide, but if you have time, you can ask the participants what other ways they could introduce financial empowerment tools from each module in their work. The next module is Module 2, Saving for Emergencies, Bills, and Goals. You will want to make sure that you take time to acknowledge at the outset of this section of the training that for some very low-income households, saving may not be their main goal. But you will also want to emphasize that saving, even in small amounts, can matter and make a big difference in their lives. You're going to kick this particular section off with a discussion about what savings is. You'll ask participants to share their own definition of savings, and then you'll share the definition of savings using this slide. After that, you'll ask participants to list examples of unexpected expenses or emergencies in small groups on a flip chart. After they brainstorm for a few minutes, have them go back and circle those that could be handled with $1,000 or less. You'll ask them to post their flip charts and share what they found cumulatively, and then you'll be able to see how many kinds of emergencies or unexpected expenses can actually be managed with $1,000. This is to contrast this idea of emergency savings with the conventional wisdom that advocates 3 to 6 months worth of living expenses. For many people, that feels like an impossible goal, so they don't even try. $500 to $1,000 does seem possible for many more people. They can imagine it, and it can make a very, very big difference. And, as will be demonstrated by this activity, they'll see that a lot of different emergencies or unexpected expenses can really be handled by $1,000. By working towards that, rather than this large goal right at the beginning, people will be able to create some emergency savings and then can hopefully avoid taking on debt to cover some of these expenses or emergencies when they arise. Once you go through that activity, you'll then define what an emergency fund or rainy day fund is, and talk about its importance in a savings plan and overall financial plan. Not only is it there to help people cover expenses as they come up, especially those that are unanticipated, but it's there to help prevent people from going into debt. In the training, there's another activity to help people further understand the benefits of emergency savings, and that's the cost of unexpected auto repair example. It's in the toolkit as well as in the training as already mentioned. What you'll ask participants to do in pairs is to look at the information contained in this chart and then identify both the monetary and non-monetary costs and benefits of each approach to covering this unexpected or emergency expense. All that important introduction information leads to the first tool, which is the savings plan. The savings plan itself is a document that outlines the reasons that someone is saving, the amounts they need to save, how they're going to find the money to save, as well as where they're going to put that savings, a place that is hopefully safe and secure. Here's an excerpt of the savings plan with an example filled in. One really important concept to talk about with frontline staff is what to do with money that's not spent in the effort to generate savings. Not spending does not necessarily generate savings. It's just money that hasn't been spent. For it to be savings, that unspent money must be moved into either a jar or a shoebox or a savings account or even onto a prepaid card to count as savings. Often, a financial education curriculum emphasizes the need to cut back to generate savings, but don't talk about that important step of taking that money and putting it somewhere to set it aside so it doesn't get spent on other things. That's how savings is generated. The Savings and Benefits tool is another tool that has been provided in this module of the toolkit. The reason this tool has been provided is to make sure that people know there may be asset limits when they're trying to save money. Asset limits are threshold numbers of the assets or savings that someone can have without jeopardizing the benefits they receive. While this information was accurate when the toolkit was published, it's important to review it with the participants and add to it any information that they may have from their day-to-day work. The third tool, Finding a Safe Place for Savings, examines the benefits and risks of different places to put savings. A benefit is something that provides an individual with an advantage, while a risk is any chance for loss. Here you can see that rather than coming out and saying that everyone should put their savings in a bank or credit union account, this tool has people examine different options for putting their savings, whether it's in a jar or under a mattress, or in an account at a bank or credit union, or on a prepaid card, or with a family member or friend. All are examined from the perspective of benefit and risk. Other information you'll cover in the context of training associated with Module 2 are direct deposit and savings, as well as bank and credit union insurance. This is obviously included to help people understand that their money is safe and secure in an institution that is insured either by the FDIC or the NCUA. But when someone is deciding to open a savings or checking account, it can be helpful to be aware of banking history reports. You should review how having negative banking history reports can prevent the opening of accounts. Ordering their report can help an individual identify potential issues. Another concept you'll want to talk about in tandem with the savings plan is the Earned Income Tax Credit. This tax credit can be a great way to jumpstart savings. It's a benefit for working people who have low to moderate income. It reduces the amount of federal income tax owed and may result in a tax refund. And in fact, it does result in a tax refund for many people. This tax refund is based on income and filing status, and information is outlined in the toolkit. Starting in 2017, consumers filing tax returns claiming the EITC and child tax credit may receive their refunds later compared to 2016 and years prior. Highlight some of the details from this issue and where people can get more information. Just like in Module 1, Module 2 has a wrap-up slide to discuss opportunities for financial empowerment. Highlight the suggested options for the given times and ask for other suggestions from the participants if time allows. Now we're going to move into Module 3, which is Tracking and Managing Income and Benefits. In the training, you'll kick off this module with a discussion about income occurrence. You'll also talk a little bit about benefits and how they're different from income, but should be counted as a financial resource coming into the household and should be planned with and budgeted for. Wage garnishments are also addressed here. Wage garnishments are rights given to creditors, including the U.S. government, to collect money directly out of someone's paycheck. This can generally only happen with a court order, but there are some exceptions, and you'll use the information that's contained in the toolkit itself to explain wage garnishments to the frontline staff that you're training. The first tool that you'll talk about is an income and resource tracker. This is just a way to help people understand and categorize, as well as document, their income on a weekly basis, not only from their job, but also from other sources. It's common in families with limited resources to have multiple sources of income and financial resources that make up a patchwork of income coming into the household. And that is why this tool can be helpful for the people you serve. They can see what income comes in, as well as when they will be receiving it. The next tool in this module is called Ways to Receive Income and Benefits. All methods of receiving income have benefits and risks associated with them. This tool can be used by individuals to look at the different risks and benefits associated with different ways that someone can receive income, and then identify the most effective method for their needs. Here's an excerpt of that tool, and you can see paper check is the example. So the definition of a paper check is included, as well as the benefits associated with it. It can be deposited into a checking or savings account or onto a prepaid card. The risks are also listed, such as if you don't have an account, you may have to cash paychecks at a bank. And the thing that makes it a tool, besides the simplicity of the information and its accessibility, is the checkboxes. This is an option that works for me. Next is the tool for ways to increase income and resources. And rather than just presenting this tool, you'll ask the participants to analyze this tool in pairs. What you'll ask them to do is circle those strategies that they think are potentially feasible for the people they serve, identify strategies that are missing, as well as think about strategies that are listed that may not be feasible. It's important to acknowledge that some strategies may not be applicable for the people that they serve and to focus on those that may be feasible. Here you can actually see an excerpt from Tool 3. And this is again just an excerpt, so there's a lot more to this tool. For example, there are one-time activities listed, such as holding a yard sale or garage sale, or selling items online or claiming tax credits. There are examples of ways to increase regular income, such as seeking a raise or additional hours at a current job, or seeking opportunities for training or education that will increase wages at a current job. And finish up this module with another wrap-up slide and discuss the opportunities for introducing the tools. The next module is Module 4, Paying Bills and Other Expenses. Module 4 begins with a Vote with Your Body exercise that we talked about in the last video. To begin with, you'll define what spending is and differentiate between the terms needs, wants, and obligations. While you're defining the terms, go hang up 3 signs around the room. This can also be done before the training begins or during a break. You're going to want them close, but not too close. One sign will say need, one sign will say want, and one sign will say obligation. And then you're going to read off a list of different things that people could spend their money on, such as paper towels, or a cell phone with data plan, or getting your hair cut professionally. And after each example of an expense that you read, you'll ask people to go and stand underneath the sign that reflects their opinion on that expense. And then you'll facilitate a discussion because people will be split on some things. Some people will see, for example, paper towels as a need, while others will see it as a want. And then the purpose of the discussion is to help everyone understand the point very clearly that needs and wants are subjective to a certain extent. And because this is a financial empowerment curriculum, we want to honor those things that sometimes people identify as needs, even if, from where we sit, they may not be. The first tool in this module is the spending tracker. This tool is set up to be an easy way to track spending on a day-to-day basis and includes categories such as savings, debt payments, housing, transportation, household supplies and expenses, groceries, and eating out. In addition to tracking spending daily, participants should be encouraged to do this over a week, a couple of weeks, or even a month. Following the actual tracking, there's an analysis section of the tool so that people can look at where they are spending and where they might want to make some changes. The next tool in this section is the bill calendar, and it's meant to be a visual reinforcement of when bills are due. This avoids late fees, cancellations, as well as reestablishment of service fees, all of which can be very, very expensive. Tool 3 covers methods of paying your bills, such as cash, check, money order, etc. This tool provides the advantages and disadvantages of each method of bill payment so that individuals have the information they need to make the best choice for them, to save them time and money. So just as in the last module's tool for increasing cash and other financial resources, this module has the sister tool, Strategies for Cutting Expenses. The activity follows the same process. Review the tool in pairs. You'll ask participants to review the tool by thinking about the people they serve, circle strategies that they think are most feasible, identify strategies that are missing, and select those they think might not be very relevant for the people that they serve. Here is an excerpt of that tool that has for its first category cutting back on regular or recurring expenses such as television, internet, phone, cell phone plan. And this tool goes on for 3 pages. So rather than just having people come up with, off the top of their heads or by looking just only at their spending tracker, ways to cut back, this tool is designed to help them get a jump start on thinking about different creative ways that they may be able to cut expenses. The final tool in this module has to do with when cash is short, prioritizing bills and other spending. And rather than starting off with a list of how to do that, there's an exercise that has the training participants examine the consequences of skipping bills. Sometimes people must make hard choices about missing payments altogether or being late to make ends meet. But it's also important for them to be aware of the consequences of those actions. And so, what you'll do is have your participants divide up into 4 groups. If you have a large group, you'll have to do 1 or 2 or 3 group 1s, 1 or 2 or 3 paying rent late versus the consequences of missing multiple rent payments, the consequences of making a car payment late versus the consequences of missing multiple car payments, and so on. And this is a lead-in to the actual tool itself. Tool 5, Prioritizing Bills, has been included to help individuals develop a short-term plan for when their income cannot cover all their needs, obligations, and wants during the month. People often pay the creditor that demands payment the loudest or the most frequently. If, and only if, someone cannot pay all their bills, do they need to come up with a short-term plan to avoid the long-term consequences associated with not paying some bills or expenses, such as losing a job, their shelter, key assets, or having legal consequences of not paying obligations, especially those that have been court-ordered. This tool has been designed to help frontline staff ask questions about decisions to help people take those first steps to building that plan. And that brings us to Module 5, Getting Through the Month. This particular section of the training begins with a discussion about what a cash flow budget is. And you'll basically ask participants to share what their definition of a cash flow is. Use participants' responses to help the group understand that a cash flow budget is a projection of how you'll get and use cash and other financial resources. You'll also ask them to contrast cash flow to a regular monthly static budget by asking, how is a cash flow budget different? The basic difference boils down to timing, the timing of income and spending, and this is key. The reason this is important is that it's often the timing of money, not the amount, but the timing of money that can sometimes cause people to fall short in a month. And that can be masked in a monthly budget, which is why a cash flow budget can be so useful, especially for people with limited financial resources. This slide and the next one will help you review the components of a filled-out cash flow budget. You can see that a cash flow budget begins with the beginning balance for the week. The beginning balance for a week is the ending balance from the previous week. Then the cash flow budget lists all the different cash or other financial resources anticipated for that particular week, and you end up with the total sources of cash and other financial resources. Then we look at the spending or the bills that are due that particular week. When you subtract that from total sources of cash and other financial resources, you get your ending balance for the week. In this example, you can see that in week 1, the individual is anticipated to be in balance and have a surplus of $122.37, which again is carried over and becomes the beginning balance for the next week. And in week 2, their budget is also in balance. We use an example to ensure people master this concept of cash flow budgeting, because for many people it will be new. They're used to the static monthly budget format. We go with an example, and the example is a scenario around Raphael, who is a single parent with 2 children. You'll explain the details of his situation, and you'll share with people the example cash flow. Ideally, you would print this out prior to the training, so each person or each team has a printed copy of the cash flow statement. The cash flow statement, the example of Raphael, is not in the toolkit. So here is the cash flow budget for Raphael, and you can see that there are some weeks that he runs out of money. When you, or the participants themselves, do the scenario analysis, they will be discussing with their partner. What can Raphael do if he anticipates these shortages? What are some things that can be done to keep the cash flow from going so out of balance on some weeks? These are the questions that you'll share to help the participants guide their cash flow analysis. You'll then go through the steps of developing a cash flow. The first thing will be keeping track of both income and spending for a week or 2 weeks or a month. And we've just covered 2 tools to help you do that from the previous 2 modules. What goals, life events, or large purchases you are saving towards should be included in the budget. Finally, you'll use this information to create a cash flow budget, either using Tool 1, the cash flow budget, or Tool 2, which is the cash flow calendar. Here is the blank cash flow budget. Once this is filled in, we can get a better look at how our income and spending works out week to week. And here is the blank cash flow calendar. This can give us more detail on the daily funds available to ensure that the money is there when the bills need to be paid. Now, when cash flows don't balance, there are 3 things that can be done. They can increase their sources of cash, income, or other financial resources. We've already talked about the tool that helps people identify different ways to do this. They can also find ways to decrease their spending or uses of cash and other financial resources. And again, in Module 4, there's a tool designed to help people think through this. The other strategy is to figure out ways to match the timing of sources and uses of income where possible, which isn't always possible, but sometimes it may be. And the third tool in this module looks at just that, strategies for improving cash flow by providing a checklist. The first group of strategies on smoothing out cash flow are really about timing. Specific strategies include negotiating new due dates, splitting a monthly payment into 2 smaller payments, or avoiding large lump sum or periodic payments by making monthly payments rather than quarterly or semi-annually. The next module is one that frontline staff will probably find themselves referring to quite a bit, and that's dealing with debt. This section of the training starts with a facilitated discussion about what is debt. Debt is often conflated with the term credit, so you'll also talk about how debt is different from credit, as well as the differences between secured debt and unsecured debt. And of course, in the facilitator notes, all of this is spelled out very clearly in case you yourself aren't completely clear about those differences. This is all a lead-in to an activity, the good debt, bad debt activity, which uses the methodology stand up or sit down. Basically, you're going to want to start this section of the training off with an explanation that some people think about some debt as good debt, and some people think about some debt as bad debt. The purpose of this activity is to challenge the common wisdom and identify the fact that regardless of the source of debt, you owe somebody money. There are bad aspects of all debt, as well as good aspects of all debt, and I say that with quotations around the good and bad. You will show each one of these debts one at a time and have people stand up if they think that the debt is a bad debt and stay seated if they think that it's a good debt. And then after each one, you'll facilitate a discussion. Those that are standing up, why do you think that this is a bad debt? If they're seated, why do you think this is a good debt? For example, loan from a family member or friend. Some people will identify this as being good debt. Why? Well, it will likely have flexible terms. It may have a low or no interest loan. Missed payments are not reported to a credit reporting agency. So those are all good aspects of that kind of loan. While there are some bad things. It can create family conflict or conflict with friends if that loan isn't paid on as agreed or is never paid. And it also cannot be used to build credit history. So if it is debt that you're on time with because you want to make sure you're honoring a debt with a family member or friend, you're not in any way improving your credit history. So again, it's just designed to help people think about the conventional wisdom around good debt and bad debt, and recognize the fact that debt is debt and that it has different characteristics to understand that. Rent-to-own arrangements are briefly covered in this module of the toolkit. Use this opportunity to explain to the training participants how these arrangements work. Understanding how they function can help people avoid potentially expensive outcomes. Present on co-signing for loans the same way. This section discusses how co-signing on a loan for a friend or family member can put the co-signer at risk of having to repay any missed payments. When it can put your credit score or ability to obtain a future loan in danger, it's good to think twice before co-signing. Medical debt is a large portion of the money owed by many Americans. For this section, you will lead a facilitated discussion of the topic of medical debt by asking participants to share some of the reasons people have medical debt. Once that discussion is completed, continue the topic by presenting ways to avoid medical debt. Being aware of options like asking for a discount on the treatment or receiving charity care can mean a huge savings to the people you serve. This diagram of how a payday loan works is not in the toolkit, but it's a great visual aid to use when explaining them. Provide details as you follow along the steps. Mentioning the common misunderstandings and facts about payday loans can provide more background to the conversation. Debt settlement services can be presented in this training as a facilitated discussion. Begin by asking, what is debt settlement? And then either as a group discussion or in small groups, discuss the questions from the slide. You may want to provide some responses to questions that are not offered. The first tool that you'll introduce in this section of the training is the debt worksheet. In this worksheet, people will basically account for all the debt that they have. To complete this, they will need to collect all their bills and get them in one place. List in the table the business person or organization they owe money to, the amount they owe, the amount of their monthly payment, as well as the interest rate they're paying and other important terms. This is just so that they have a realistic idea of the debt that they owe. The second tool in this section of the toolkit is the debt to income worksheet, a simple calculation that shows you how much of your income is going towards paying debt. It's a good measure of how much income is basically obligated to debt. You'll explain how to calculate it, and it's really quite a simple calculation. The hardest thing is coming up with the total monthly debt payment, which is the amount of debt that someone pays per month. So, it would be what the monthly auto loan payment is, it would be what the payment is to the credit card company each month, it would be what the monthly student loan payment is, all added together, and that is the total monthly debt payment, divided by gross income, not net income. This shows the level of debt that people may want to consider as the maximum level to ensure that payments are sustainable for them. It's divided into renters and homeowners because renters don't have a mortgage and therefore don't have housing debt that homeowners do. In other words, a renter may want to consider maintaining a debt-to-income ratio below 15% or 20% to ensure that their debt levels are sustainable. For example, if a debt-to-income ratio comes out as 50%, that means that 50 cents out of every dollar earned is going to pay for debt, and that only 50 cents is left over to pay for things like taxes, food, rent, gasoline, and so on. For people to understand debt-to-income ratio a little bit better, there's an example provided in the training, not in the toolkit, but in the training, and this is the example. And you'll have people again, either with a partner or in groups of 3, calculate the debt-to-income ratio for Shauna in this example based on the information provided on this slide, and then have a judgment. They'll make a judgment as to whether they think that she can afford this new loan as described in the exercise, given her debt-to-income ratio. Tool 3 is the Reducing Debt worksheet, and there are 2 primary methods for reducing debt outlined here: the highest interest rate method, as well as the snowball method. One of the things that the worksheet does is highlight the pros and cons of each. The highest interest rate method basically says that if you're paying on all your debts and you have any money left over, put that extra money into paying off the debt that has the highest interest rate first, because you're paying a lot more for that debt. Versus the snowball method, which says you should identify the debt that has the smallest amount owed in total, irrespective of interest rate, and pay as much as you can to eliminate that debt as quickly as possible. Once that debt is paid off, you continue to make the same total payment amount, but obviously not to the creditor that you've already fulfilled your obligation with. You take that same payment and now you lump it in with the next smallest debt until that one is eliminated. And then you take that total payment and apply it to the next smallest debt. So you're basically creating a snowball running down the hill. It continually gets bigger and you apply it to each debt as they get bigger. Tool 4 is the Repaying Student Loans tool, and it basically looks at the different kinds of student loans that are available, specifically federal student loans versus private student loans, and it goes through an explanation of the different options for repaying student loans, as well as some of the key terminology around student loan debt. One of the things you'll want to be sure to highlight in this section of the training is the Paying for College tool on the CFPB's website. This tool provides information as well as resources and tools to help prospective students as well as current students research schools, fill out the FAFSA, choose a loan, compare financial aid packages and college costs across more than one school, manage money while in school, and explore options for repaying student loans. If you have an internet connection when you're training, it would be great to pull this up during the training and explore the tool online with the participants that you're training. The last tool in this module is When Debt Collectors Call, and it looks at your rights and responsibilities around debt collection. It also includes example letters to write to creditors or debt collectors, specifically asking them to verify or prove that debt is owed, or even to ask them to stop contacting you. Here, you will present highlights from the Fair Debt Collection Practices Act, including who is covered by the law and the limitations it places on debt collectors. The next module is Module 7, Understanding Credit Reports and Scores. The first thing you're going to do in this section of the training is to cover the reason that credit reports and scores are important. The importance of the reports comes from how it's used in decision-making with respect to consumers and who is using it. The first example is that a bank or credit union will use them to decide whether to give someone a loan. A lender may also use them to decide what interest rate someone will pay for a loan if they are approved. A credit card company will use credit reports and scores to determine whether someone will get a credit card and, again, the rate they may pay. Other service providers, like cell phone companies and utility companies, may use them to screen people for deposit levels as well as cost of service. An insurance company may use reports and scores to determine whether to give someone insurance coverage and the rates they will pay for that coverage. A landlord may use the reports and scores to determine whether to rent an apartment to somebody, and again, what level of security deposit may be charged. Finally, a potential employer may use reports to determine whether someone will get a job. Next, define and differentiate the different sections of a credit report. One of the things to remind the participants that you're training is that while formats vary among different credit reporting agencies, or consumer reporting agencies more specifically, that they all have these 5 sections in common, even though they may show up in different orders within the credit reports, or may be called slightly different things depending on the formats used. It can be confusing how long information is kept on your credit report. While most items stay on for only 7 years, some items, including bankruptcy, stay for 10 years. So use the slide and information from the toolkit to summarize how long negative information will be reported on your credit report, and in what situations that negative information can be reported beyond those time frames. Within the toolkit, you'll see that there's an example credit report, and it's a generic example. While it's based on some elements of all 3 major credit reporting agencies, it does not represent any one of them. Instead, it's meant to just give practice in looking at the kind of information that's contained in a credit report. And to do this, you'll have them sort of go on a scavenger hunt into the credit report by finding the information that's listed on this slide within the example credit report. And of course, the examples are included in the facilitator instructions of the training slides. You'll also want to cover the 3 major credit reporting agencies: Equifax, Experian, and TransUnion, as well as the way to get the free annual credit report at www.annualcreditreport.com. Be sure to mention imposter websites and how people get tripped up with imposter websites if they Google free credit report or free annual credit report. It is also helpful to show people how to get their credit reports through this website and how they will be asked to enter some personal information and then choose, do you want your Equifax report, your Experian report, your TransUnion report? And then you'll have to go through the process for each of the credit reporting agencies separately to get the credit reports from them. It is not a one-click process. Use the following screenshots to show the process of pulling your credit report. If you have an internet connection, consider going to the website and showing where to click to request your report. For any number of reasons, you may not be able to pull your credit report online. In this situation, you will need to mail away for your report. This is the screenshot of the document to be mailed in. You'll also want to explain that credit reports are generated from information that is provided to them by information furnishers. Information furnishers are mostly the same organizations or businesses that use credit reports to make decisions. Banks, credit unions, credit card companies, student loan providers are all organizations that provide information to credit reporting agencies, and it's that information which is used to create the credit reports. Credit scores are calculated based on this reported information on your credit report. Use the information on credit score composition from the toolkit. Although there are multiple different credit scoring models out there, we chose to go ahead and have you focus on the FICO score because that's the one that's most commonly used, between 85 and 90% of the time when it comes to decision making. And basically, you'll use the notes from the facilitator instructions to explain the composition of the FICO score itself, which you can see in this pie graph in front of you, but there's much more information in the facilitator instructions themselves. A major piece of your credit score is your credit utilization ratio. To get the best scores, it is recommended that you use less than 30% of your total credit limit. In this example, if you have a $5,000 credit limit and you are charging $3,500, you would have a utilization ratio of 70%. Another scoring method that is used is the Vantage score. It differs slightly from the FICO scoring models shown before, but it still uses the information from your credit reports. It's very important to understand the information in your credit reports and make sure it is accurate. The first tool is obviously going to be getting your credit reports and scores, and it's a step-by-step in table format on how to order your credit report. It's very straightforward and easy to follow, and there's also a recording section so that people can keep track of where they ordered their report and when they received it. A best practice is ordering and reviewing credit reports at least once a year from each of the 3 major credit reporting agencies, Equifax, Experian, and TransUnion. The second tool is the Credit Report Review Checklist, which you can simply follow to make sure absolutely everything is correct on your report. If you find that anything is not correct, you can file a dispute. Disputes can be filed online or by mail, and it may be necessary to contact both the credit reporting agency and the source of the mistake. Tool 3 is for improving credit reports and scores. Just follow the recommended strategies and check the boxes on the left of the table as the steps are completed. Finally, Tool 4 covers why it is important, keeping records to show you've paid bills. Instead of simply presenting this information, use the questions to hold a discussion about what it means to create a paper trail and what financial records they think someone should keep. Tool 4 provides a list of important records which can be checked off when the documents are collected to create the paper trail. The tools in Module 7 are meant to be used together. For ordering your credit report, use Tool 1. For reviewing your credit report, use Tool 2. For improving your credit report and scores, use Tool 3. And for proving you've paid bills, use Tool 4. Now we will discuss money services, cards, accounts, and loans, finding what works for you, covered in Module 8. The Your Money, Your Goals Financial Empowerment Toolkit does not focus on banks alone. It looks at financial service providers more generally. And as you can see from this list, there are a lot of financial service providers. There are obviously banks and credit unions, but also department stores, automobile dealers, check cashers and payday lenders, online companies, mortgage companies, and so on. There are many different financial service providers that operate within our economy, and that's an important point to understand. The first tool in this section has to do with selecting a financial service provider, and it's something that you'll have the participants complete in the training. Rather than prescribing a specific financial product or service, the toolkit takes the approach of matching need or goal with financial products, service, and provider. And that's really the purpose of this tool. So as explained, this tool was designed to identify the needs and wants of the individual, and based on their response, they can begin to identify product or services that meet their need, as well as where to get that product or service. This is the second part of Tool 1, and it's basically an answer key for the rankings for what someone did in the first part. For example, if someone ranked that they want to get small loans quickly and without a hassle, they would learn from this tool that a credit card company has a credit card, a pawn shop has a pawn loan, a finance company has a signature loan, or a payday loan provider has a payday loan. All four might be able to satisfy the customer's desire for quick credit. This is a financial empowerment approach to financial products and services. It matches need with product and service with provider. The next tool now gets into choosing where to get what you need. Training participants will review this tool individually, and then you will facilitate a discussion using the questions on the slide. Make sure that you identify the needs-first approach being used to provide guidance on selecting a product or service. Tool 3 basically has a list of all the different financial products and services that are commonly available at banks and credit unions. And again, rather than present on this, you'll have people get into groups of 2, and you're going to give them a product or service explanation template, and they're going to fill it in using these instructions. Here's an example of what that template looks like. They'll come up with a definition, where someone can get that product or service, when someone would use this product or service, as well as the benefits and risks associated with it. They'll use information in the toolkit as well as from their own experience to fill this in. And once you give people about 5 or 10 minutes to complete their information template, each pair will then present their information to the entire group. So it's a teach back using these templates. The fourth tool in this section of the training is opening an account checklist. And you'll kick off the introduction of this tool with the facilitated discussion about whether anyone can open an account at a bank or credit union, as well as should everyone open an account at a bank or credit union. The first one is fact-based. Can anyone open an account? The answer is no. Someone may have a negative check system rating, a poor credit report, or they may not have the money to open an account at a bank or credit union. The second question is, should everyone open an account at a bank or credit union? This is an opinion question that will help you understand some of the opinions of the frontline staff that you're training. The checklist itself then covers all the things that are needed to open an account, including the types of identification banks and credit unions accept for opening accounts. Here you will present overdraft coverage from the information in the toolkit, explain its purpose, how it works, and review alternatives to using overdraft coverage. Tool 5 of this module is money transfers and remittances. It will be helpful to define a remittance transfer for those participants who are not aware of the service. Then review the rules and what should be included in the disclosures. And just as a reminder on these wrap-up slides, they are great ways to start brainstorming on how the frontline staff being trained can integrate these tools into their work. The last content module has to do with protecting your money. The first tool in this section is submitting a complaint to the CFPB. This slide shows the various categories of complaints handled by the CFPB. Consumers can submit complaints about consumer financial products or services. They can do this either online or by calling a specially designated number from the CFPB. One thing important to note about this process is that an individual can submit a complaint on behalf of someone else. This is what an actual complaint intake interface looks like on the CFPB website, And again, you can see that you can submit a complaint on behalf of oneself or on behalf of someone else. The second tool in this module of the toolkit is protecting your identity, and it has a checklist of all the information as well as the documents that people should strive to protect. It also includes a list of the signs of identity theft. Here is a picture of the checklist. The third tool in this section of the toolkit is identifying red flags for scams, and the way you'll animate this in training is using skits. You'll actually have people act out different skits where they use some of the different red flags for scams that someone may encounter with different financial products or service providers. And the group watching the skit will try to identify the red flags they're observing by using the tools. This gets them familiar with the tool in a way that is hopefully fun and engaging. Here are some of the different red flags, for example, that can be used within a skit. The fourth tool in this section is a summary of key consumer protection laws. And again, rather than a presentation, groups are invited to read about and then summarize back to the large group a presentation about the law or regulation that their group has been assigned, as well as why that law matters to the people that they serve. One of the things already mentioned in the earlier videos is the resources available on the CFPB's website. You'll want to go ahead and highlight those for participants throughout the training itself. The CFPB website and where to go to submit a complaint is actually noted in the toolkit multiple times and again at the conclusion of the training. In addition to the resources available from CFPB, the toolkit includes a resources section that provides links to third-party groups based on topics related to the modules of the toolkit. Please be aware that by including third-party resources, the CFPB is not endorsing and has not vetted them. The final thing that you'll do in the training is the closing activity, as well as administration of the post-training assessment, if that's something you're choosing to do with your training. As I mentioned before, the purpose of a closing activity is basically to provide closure to a training. What we have provided is basically 2 questions that you can ask people to respond to using round-robin format, which means you go around the room in an organized fashion, giving everyone the opportunity to speak one more time. You can, of course, feel welcome to substitute your own closing activity at this point in the training. So now, congratulations are in order. You've not only completed video 3 using the tools, an explanation of how the tools are covered in the training, but you've actually completed the entire Your Money, Your Goals training for trainers. So now you're all set to go and train frontline staff and volunteers in your community or your constituency on using Your Money, Your Goals.